Alright folks, as the stock market begins to flatline today, I thought it'd be fun to divulge down into that scam-filled comment section to see if there was some real thoughtful comments, questions that I could offer some insight on, and damn it, weaning through it all, I found a bunch, whether it's related to my own personal portfolio performance, my parents moving into retirement, us leaving Toronto, Bitcoin, GICs, REITs, and so much more in between. If that is something you think you'd appreciate in this video, consider hitting that like button, because I may just do a live stream, a live Q&A toward the end of this week, but it depends on how many of you actually like the video, and if you leave some comments down below, maybe I'll bring them up in the live stream. But first and foremost, Nitin Balin, if I'm saying that correctly, Balian, if I'm saying that, Nitin Kitten is what I'm going to call you, because you're asking, beating Warren Buffett, did you compare net dividend return? So this is probably related to me gloating about my portfolio performance, because I don't have $1 million. Sometimes you got to have something that says, here's why I'm good. And the only thing that I got is, damn it, my portfolio performance, because Berkshire Hathaway, guys, since the inception of my investing career back in September of 2014, is only up 101%. That's nothing to gawk at, by the way. That's good numbers there. ARK Innovation, somebody else. I always outperform Kathy Wood and Warren Buffett. It's like one of my quotes here, because the ARK Innovation ETF since the inception is close to when I started investing, and it's only up 72, 73%. And as I've shown you in the past, here's my portfolio performance since the inception. And my main account, my TFSA, is up 124%. The longest standing account I have is my managed cash account, which is up 262%, and my RSP up 218%, not taking into consideration my corporate account, which is down since the inception. It's down about 20%. Bringing it all together, I'd probably say I'm up about 180%, give or take, damn near doubling the performance of Buffett. So to answer your question, yes, this chart here takes into consideration the dividends along with the capital gains total combined. And again, you know, I don't have millions of dollars, so I can show you this, so at least you know where I'm coming from when I'm trying to talk about a topic I think I understand. JT asks, I thought you held a bunch of individual stocks. Did you switch to mostly index funds now? I'm thinking of doing the same. So if you go back to my videos from Q1 to Q2 of this year, I was losing my marbles, not sure of what I was doing, kind of selling out of some tech stocks, buying into dividend stocks, but I didn't have time to manage it all. And sometimes I have a hard time owning a whole convoluted portfolio of stocks when I don't have enough time to do research on them. And I feel like from a passive and just comfortable sleeping standpoint, for me personally, it was just easier to buy the indexes, because like Vanguard's VOO, the S&P 500 index, let's use Meta, Facebook as an example, I would have got totally wrecked if I kept cost averaging into that stock, whereas VOO auto weights the stocks based off their market cap through a mathematical equation, no emotion involved. So Facebook was once on the top 10 S&P 500 list. Since its market cap has gone down so much, it gets auto-weighted down the list, so your exposure isn't nearly as large, and that cushions you from the downside risk, but also puts the best possible companies at the top during a recession, so you get kind of equal weighted performance. And then once the bull market comes back, you can still take advantage of some of the upside. And same with just my dividend ETFs. It just takes so much management off the table for me. But nonetheless, I do appreciate the comments. So Fabio kind of had a related comment saying, can you explain why do you consider RioCan more secure than Smart Centers again? I have both, but I think I have a larger position in Smart Centers. Thank you for the video. I just started investing, and and it's been helping me a lot. So first, I really appreciate that comment. I'm glad that some of my advice can offer some insight. But first and foremost, RioCan as a company I understand very well. I like the new management. They're doing share buybacks. They don't dilute shareholders. It looks like they're prompt toward actually getting RioCan to become a growth company again. And I understand RioCan's real estate very well, whereas I don't understand Smart Center nearly as in-depthly, and you're kind of only good as the knowledge you have. So from my own ignorance, I'm a little scared of Smart Centers. I do own it, mind you, but they do share dilution for growth, which all that dilution hasn't really equated to much other than some moderate dividend growth, where something with like a Granite Real Estate Investment Trust, that dilution had like exponential growth. So it's just, REITs are by far one of the hardest balance sheets you're ever going to understand in the market. It's not as clean cut and dry as something like an Apple or an Amazon. So do take that into consideration. And I think diversifying REITs is probably the smart thing to do. But hey, I do own Smart Centers and I do own RioCan. So let's get into this with a funk spinner. Remember when Bitcoin was proclaimed the non-correlated asset, a medium of exchange, a store of value, and a hedge against inflation? Oh, well, this is awesome. Yeah, I think people kind of got left blindsided and slapped upside the head when it came to what they actually thought Bitcoin was. But I will tell you, I still own my Bitcoin. I don't promote crypto as often because I just don't want people getting as bad into it as they did. However, my thoughts on crypto comes back to the centralization problem. When you're talking about people like Andrew Tate, Yeezy, these people are getting banned from banks. I mean, we're moving into a world where anonymity doesn't really exist anymore. and it's just giving too much control to centralization. So for that reason, I think Bitcoin is a non-correlated asset. It does trade with the market, but I think crypto, just having a small piece of it in your portfolio, I think it's got a long way to go. Bitcoin might not be the dominant one 10 years from now, but it is like the new era of the internet. And I think for as long as centralization continues to take over, people are going to always be inclined, especially people from other nations where they can't trust their currencies or their government, will be inclined to use crypto. And I think this will bleed better and it'll give us better gains as gaming and more adoption comes into play. But my personal preference, and again, I only have less than 1% of my portfolio in crypto. Keep that in mind. Lex says ETFs are good, but I prefer to buy individual stocks. Does it make sense to buy ETFs with a 3.85% dividend like yours if you can put it in a GIC where the dividends are over 4% per year guaranteed? Thank you for the update. This truly comes down to your own personal preference. Where are you at in your life? What kind of return do you need to retire? Now, if you're in a retirement phase already, I would be more focused on guaranteeing with the lowest amount of volatility risk, getting that 4% income. And you can do that with GICs and bonds right now. It's incredible. But for me personally, because I'm very young, I have a long time horizon ahead of me, I don't want to give up growth. So I could easily get my portfolio to yield 4 to 6%, but I don't want to give up the potential growth when the bull market comes back around. So I would much rather try and average around to 3% by buying things like the S&P 500 index along with higher yielding ETFs like VDY, get a balance of both that I could tap into if I ever needed it for an emergency. Let's say I have a pure access to almost $1,000 a month in dividends, but I won't be sacrificing the growth in the long term, because I think, with my 30-year time horizon until I'm 60, that inevitably the market will start to offer better returns than something like a 4% just from a GIC. So again, I think that's very circumstantial. Now, I was wondering, coming from Carlo here, who inspired your hairdo? Funny question. This is a 90s haircut. I'm a 90s kid, but I was also a full-time magician for 10 years. It's kind of a magician-y haircut, I guess, and you kind of use it as branding, so I never really changed it. And now I don't know what to do with it because nobody likes when I do anything different with it, and I'm kind of scared to cut it short because I have my dad's hair, so I'm getting a bit of a widow peak here. Could start losing this soon, so we're going to keep it kind of brushed forward, make it look like there's still hair there, I guess. Funny question, but nonetheless, Mr. Financial, yet again, you comment a lot. I appreciate it. These figures point to why, this is related to us moving out of Toronto. These figures point to why geo arbitrage provides a big opportunity in Canada and the US. Why live in the most expensive part of the city when you can save hundreds of thousands of dollars by living in less expensive parts where you still have access to high paying jobs? So this, again, very personal to your own circumstance. And you have to understand, we have unlocalized jobs. We work from home. Me and my fiance, we have enough in savings right now that if we move to Edmonton, our savings alone could pretty much cover almost 80% of our entire living expenses, because the cost is so dramatically cheaper of living in Edmonton, right? And this is a problem in like California, let's say you live in San Francisco, where I just was on vacation. I mean, let's say you work for Facebook, you make 350, 400,000 a year as a tech. Well, first and foremost, you're almost taxed at 50%. So you got 200K left over. The cost of living and housing is insane. And before you know it, you're living a middle-class lifestyle, making 400,000 a year. That's the same problem here in Toronto. I don't see, for whatever reason, why I'm stuck here. I'm like, what do I like here in Canada or Ontario? I like Canada's Wonderland. Yeah, I like driving through Toronto. I've had my experiences here. I've built my whole career here. But at this point, I'd be rich if I went to Edmonton. Like, I'd feel like I was a millionaire. Whereas here, I'm always going to feel broke. And I think that's a big problem for standard of living. If you want to have a family, if you want to have a reasonable, comfortable life, it's very hard to do so without a very high degree of income in Toronto specifically. So that is something I'm taking into consideration. A lot of people criticize me about that in the comments section below. But again, it's your own personal circumstance. I would like to be rich. I'd like to have a comfortable lifestyle. And I understand why that's so hard in Ontario specifically. So Savage Investor. Hey, just wondering if you're ever going to make a video about your parents' retirement and their transition. I think that would be a really interesting and could help a lot of people who will find themselves in a situation in the future. I'm going to deal with my parents' retirement in 3 years, and I can tell you it's not going to be easy. So I can't talk a lot about this for legal reasons. My parents are kind of caught up in this real estate crash going on in Ontario, and they've been desperately trying to transition into retirement, and I've been helping them along the way. Perhaps down the road, I will be able to make a full video on this, but if I can just offer some really quick clerical insight, you got to ask your parents, what is it going to take for cash flow for them to retire, and how much savings do they have? Now, in the current market condition, what I would recommend is if you're just looking for a safe, stabilized 4% cash flow, and that would cover all your expenses, then you need to find the least volatile, most safe aspect of doing so. And I would really take advantage of GICs. because GICs are government-backed debt guaranteed investment certificates, guys, that can yield 4% on a 6-month. So you can claim it after 6 months at maturity. So what I would do, and I told my parents this as well, is take 30% of your parents' portfolio, and for the next 6 months, focus on a 6-month GIC, but divvy up that 30% over a 6-month contribution limit. So every month you're divvying that money up into a 6-month GIC. So by the time you get to the end of the 6 months, it'll start rolling over into the next month. And then you take the interest that was earned and then reinvest the initial investment back into a GIC and keep doing that every month. Because then through a 6-month period, you'll start getting rolling over month cash flow. It's a little bit more active because obviously you have to reset them every month and you have to wait the first 6 months for it to catch up. It's kind of an interesting way of doing things. And then I would focus on a high yielding ETF, VDY, something they don't have to manage, get another 4%. And then I take another 30% and focus on dividends / growth because unfortunately, yeah, it sucks when the market does bad, but you don't want to miss out on all the gains when the market does well. So maybe buy something like VOO. And, as the market does excessively well on certain years, draw against it on those years, take some capital gains, use it for travel, whatever, right? So that's kind of what I'm thinking for my parents. So one more here. Luke, let me zoom out a little bit. Let's see what's going on here. Luke says, I don't think we've seen the end of this yet, talking about the market crash. We've seen no solutions. Inflation is still high. I'd argue that it's not still high. The Fed takes data off the trailing 12 months. If anything, inflation's completely back to a nominal rate. Go just calculate inflation from July till now, and it's at 2%. The Fed will keep raising rates to tackle that. I do agree. I think they're going to keep raising rates. Planned layoffs, the energy crisis. There are a lot of reasons. Nobody truly knows, though. So keep dollar cost averaging and catch all the lows. So I'm not trying to necessarily predict the bottom of the market. I just look at the discounts that are available. I see that there's a ton of fear in the market. And those indicators to me, value plus fear, means that, the S&P 500 right now, I'd argue, is trading for fair value. But VDY, some of these Canadian stocks, the banks, there's so much value out there that I think now is the time to start being aggressive. And I'm just going to be, and we'll see how it works out. Consider subscribing because obviously I'll update you if the market tanks. I'm going to get hit pretty hard investing, 20,000 here over the last month. A little comment from, again, Mr. Financial, you're all over the place. Well put, Luke. No one can forecast the future. A hurricane cannot be forecasted. Just the market turmoil can't. Why people and professionals, I guess, keep trying is beyond me. It's good to keep investing and staying invested, though. When the market turns for good, you don't want to be late to the party, and that is something I agree with, guys. If you're not buying stocks or doing the cost average and you think you're going to time it and you miss the initial bumps, you're going to miss out on most of the gains because they happen within a blink of an eye. But at this point, I'll pass that question off to you. Let me know what you think in the comment section below. Ask me a question, and perhaps we'll come back and do another Q&A session. But stay cool, stay awesome, and as always, I look forward to catching you in the next one.